Hello, everyone. Welcome to our second video here from Mykonos Financial Consulting. My name is Vasily, one of the partners at Mykonos Financial. And just like every time, we're going to be sharing useful tips, whether it's finance, consulting, business strategy. Today, we're actually be going over specific stock valuation, so showing how we value stocks. And it's actually through the DCF method is one of our favorite ways to do it. So this is not only going to be an educational video for, those looking to invest in stocks, but also for students in college and finance and accounting who are learning how to do a DCF model, how to value a stock. So with that, let's get into it. So what you guys are going to see over here is going to be a Apple stock valuation. So I chose Apple because um, it's a pretty well known I'd say, firm. It's in the top five in terms of market cap. But with that, comes a lot of, generalizations and different conclusions that we're going to make. So first and foremost, we have Apple. And now, just to give a little bit of background, there are multiple ways you can value a stock. One is through the discounted cash flow method, which is what we're going to do, which is forecasting future cash flows. But for companies that are smaller, such as a startup or a tech firm, you might be using multiples valuations, which you guys can see below. That'll be a completely separate video. So we're doing this one for transparency for our clients, and secondly, for students who are learning the DCF and valuation models. Now, to continue and really begin on this, what you guys will see is obviously we have the ticker, the Apple ticker, and we have a historical and a forecasted value. So I'm recording this in the beginning of 2026, but since I've completed this a couple months ago, we're going to use the 2023 and 2024 numbers, and we're still going to act like we're going to estimate 2025. So with that, let's go ahead. So first, we have operating cash flow. Operating cash flow is when a company does its business and it's the kind of cash flow they get from operations. It's kind of what it says. So them doing business, them doing sales, and so forth. Here we see the number 110,543,000. But as is the case with many big firms like Apple, you see that it's in thousands. So this is actually $110 billion dollars. Basically, so this is kind of like our historical. This is what we're getting our information from. If you go to something like Yahoo Finance, which I've pulled up here for the Apple ticker, you can see that for the year ended 2024, the operating cash flow was 110,543,000. Again, this is in thousands. So we just transfer that number over here. We did the same thing over here with 2024. You guys will see over here, 118. So basically what we're doing is copying and pasting from Yahoo Finance. Now, as a part of the DCF calculation, you also need to get CapEx, which is capital expenditures. So remember that operating cash flow is your main. What is the cash flow? The operating cash flow of the business. Then you have CapEx, capital expenditures, so different expenses. And lastly is the repayment of debt. So if you make a payment to debt, say they owe 100 billion, they just paid 14 billion here in this, instance of 2024. Now, given that we have the historical numbers here and we've got the free cash flow calculated. So if you guys take a look, operating cash flow minus the CapEx and then minus the debt. So in 2023, we didn't have any, but in 2024, we used the most recent number. They did in 2023, just to clarify, but we're using the most recent number. The free cash flow here is shown, right? Okay. Once this is done, we have a number to base things off of. So below, you guys will see the cash flow year over year growth. And this just says how much do we expect the cash flow growth, meaning, the free cash flow, to grow every year. And what we simply do to get our historical, we'll use 2024, we subtract from 2023, and you make it into a percentage. So as you guys can see, you do C4, which is here, 2024, divided by 2023, and then you subtract 1, which is the 100%. And we get about 7%. Now, as you forecast, and again, this is going to be very different depending on the business and the structure and the industry and things like that, your growth rate will change. So since they had a 7% growth rate, we are like, okay, well, we're going to have another year of 7%, and we're going to take it down all the way to about 3%, which is the inflation roughly, meaning that there's not really much growth, but it's kind of meeting pace with inflation. And that's 5 years out. As you guys can see, we go 2025 to 2029. For most DCFs, you want to do a 5-year stretch of forecast. Now, then it's really simple. So we have our historical values, we have our free cash flow, we have our cash flow year over year growth, and this is again estimated. So here, what we're going to do is all we're doing is we're taking the 2024 value, $118 billion, and we multiply it by 1 plus the percentage. So this is 7% increase that we estimate. That's 126 billion. 134. And you just keep going with the new percentage. So 2026 forecast would be based on the 2025 operating cash flow times the cash flow year over year growth that we're expecting for 2026. Pretty straightforward. Now, switching to CapEx, you guys can see that we also have, the CapEx values pulled in here. All we did for that is simply take the CapEx of the historical, which is the last year that we had, which was 2024. And all you do is you're going to divide it by the operating cash flow. It gives you a ratio, and that's a negative 8.45%. A simple note here, you keep CapEx steady throughout the same, you keep it the exact same. So that's why we have a negative 8.45% as the CapEx, as a percentage of the operating cash flow. And lastly, the repayment of debt here, you guys will see is stagnant, the same. And that's because we don't know what management's going to do. You don't know if they're going to pay off more debt or less debt. So you keep it steady, consistent with what's been going on. Now, we basically have half our model done, right? So we have that here. We have all our cash flows based on the cash flow growth. Then we have the CapEx, which literally all you're doing is multiplying the CapEx as a percentage of the forecasted operating cash flow. And feel free to play back, slow this video down if I'm going a little bit too fast. Now, with that, we get all these different free cash flows, right? Perfect. We reach 2029, which is 5 years out, and we're like, okay, what do we do now? In the DCF, you have your forecast, but then you have the terminal value. And the terminal value is the growth, estimating the value of everything at the constant growth rate. So in 2029, we expect it to be 3%, right? And we're making the assumption that it's going to be a continuous growth rate of 3% from 2029 till forever. Given that, all we do, and I'll show you guys this formula, is basically we'll take our free cash flow value of 2029, right? Which is 138 billion that we forecasted. And we multiply it by first the WACC, which is the weighted average cost of capital. And then below that, as you guys can see the divide here, we do the WACC divided by the growth rate. Now, this might seem a little confusing, and I completely understand that. Basically, what this is saying is that the growth rate down here forever will be 3%, right? That is our estimated assumption. The weighted average cost of capital is what is the cost of capital? So what is the implied cost of getting funds? And if we think back to early business, you can get you can get funds through two ways. You can either raise debt, which is bonds, other secured notes, take in loans, or you can give shares, which is equity. And we have a little bit of a breakdown down here. Now, at the time when we did this in late 2020, when we did it for 2020, we did it in 2025, but obviously we're reflecting these historical values. We looked up the liabilities of Apple. We looked at the assets and we looked at the equity. And with that, we also looked at the tax rate. Mind you, you can get everything of that here in the Yahoo Finance. So instead of cash flow, we'll look at the balance statement, balance sheet, and it might take a second here to load. You'll take a look at the balance sheet for the assets. So you guys will see here we have total liabilities, total debt, and so forth. Basically, though, with that, we kind of have a breakdown. And if you guys aren't accustomed to what WACC is, completely understandable. Typically, you can get an industry average WACC. All we did down here is break it down, though. Now, going into the specific breakdown, we see that the liabilities make up 60% of the assets, right? So the assets are 142 billion. 85 billion is liabilities, but they also have about 60 billion in equity. Well, all you do is you figure out the tax rate because debt is not taxable. Remember, you get to deduct the interest. You get to deduct the interest on the debt. And we went to a simple, Google search and we figured out what the cost of capital is for liabilities and what it is for equity. And this is specifically to the technology sector. So you have Apple, you have Microsoft, and things like that. These are genuinely pretty ballpark, right? This is used to calculate our WACC, which you guys will see here in this formula. So all you do for the WACC is you take obviously the percentage of your debt, which is 60% of our assets, and you multiply it by the cost of capital that is provided. And a lot of times you get this off the internet, right? So NYU is probably my favorite tool to use. If you do a simple Google search, NYU weighted average cost of capital for tech, it'll pop up. So there's about a 6% for debt. But then this is why we have the tax rate. You have to subtract the tax rate from the cost of capital here because you can deduct interest on taxes. So that is the biggest kind of thing about calculating the WACC. And then all we have to do for the equity part is multiply the equity part by the cost of capital. And we can see that the cost of capital for equity is a lot higher than debt. And again, it's because of the tax provision, the fact that you can deduct interest on debt. Now, once you understand that, and again, we can get a WACC ready for us too, but it helps calculating it a lot of times to break things down. We have our WACC, we have our terminal growth rate, we've gotten our CapEx rate, we've gotten our cash flow growth rate. That's when we calculate that terminal value because we're using that final free cash flow value that we have plus, if you guys see the WACC, times the one times the WACC, and then you're dividing it by the WACC and the growth rate because think about it, the weighted average cost of capital is almost 6.5%, and your growth rate is 3%. That difference is what is going to fuel your valuation. Might sound a little iffy, but trust me along this process, it is pretty simple. So we have the WACC, we have the growth rate, we have our terminal value calculated. That tells us that everything after 2029 with our free cash flow asset forecasts, you can tell that we're going to have this is a huge number, as you guys can tell. It is absolutely massive. This is the value after 2029. And all we had to do was that 5 years gets us to that growth rate that we think that will continue on forever. Now, here's where we go to the present value. And you can calculate this using Excel pretty easily. But what we see is NPV, which is the net present value. And all we do is take basically the WACC that we have, the weighted average cost of capital, and we take all of our future earnings from the forecast right here. So you guys can see 2025, 2026, all the way to 2029 are highlighted. And then that's net present value. Basically saying anything in the future, discount all the interest rates and expected investments and everything like that, bring it to the value today. What is that worth today? And you add the terminal value that we calculated because we did already all the calculation for the terminal value. We know that the growth rate is going to be 3% for Apple in this case, forever, in our estimation. And that allows us to bring down the value of the terminal value to a certain number. So all we're doing is adding it to the net present value of these forecasts. So basically, long story short, we're taking the terminal value, which is everything after 2029 generated, and we're taking 2025 to 2029, combine that, and it makes that combination, we bring it back to today. So you're bringing back 2025 to 2029 today, and then you're having everything in the future already brought back today through the terminal value. We're almost there. So we have this massive amount of present value. So the present value here is $4.6 trillion for Apple. That's our valuation. So that's what we're saying. It's currently valued, the present value of it now, as an organization, as a company, everything. Well, you have to take into account how many shares there are in the stock market. And we go ahead and take that number, which is 15 million shares. And all you do is a simple division. You take the present value and you divide by the shares. And that gives us a share price valuation of $307. Now, if we take a look at Apple today, it's worth 262. What does that tell us as investors? It tells us that there's a great upside. You have $50 that you can gain on 250, which is about a 20% implied return. That tells you that there's room for growth in the market. And it's a great way to kind of weigh if you're way off, like you think this stock is going to blow up, but in reality, is it? Is it truly invested or is there some bias in there and things like that? This gives us the purely financial perspective. I also will say this is very great of an estimating tool because, for instance, take a look at 2025 where we forecasted, right? We said that the operating cash flow will be $126 billion, right? Up from 118. Well, if we take a look at the cash flow, and mind you, this was done prior to this coming out. We'll let it load. But you're going to see how close we actually came to that kind of prediction. So we're at 118,000, right? We predict that there's growth, 126 billion, and then we see that the next year was 111,000. Sorry, 111 billion. Now, first you might be saying you're so off. I mean, you lost 7 billion, went back to what 2023 was. But you got to realize this 126 billion to 111 is only about a 10-12% miss estimate, right? So even though our forecast isn't 100% accurate, that's when you adjust. When you see different calculations and different changes, we make changes. So based on what I would see, say I was doing this for this year, I could change the growth rate to 4%. And if you guys see, look at our share price. If I change that and say 3, 3, 3, and let's say we end up with 2% growth rate, right? I go ahead and change these metrics. It tells us our share price is $222 if we're kind of updating the metrics, right? If we think that the growth rate will be way lower, because last year there was a negative growth rate. But if you take a look here, look at the share price of Apple, $262. What do we see here? $222. So we see an undervaluation in the Apple stock. And that kind of tells you that obviously you have to manipulate with certain numbers and certain forecasts, but it's one of the best ways to do valuation. And it'll help you with your personal finances. It'll help you if you're an investor, help you if you're a finance major and you're doing these calculations. But for me, it's honestly my favorite tool to do valuations because you can mess around with the cash flow growth. You can mess around with the terminal growth rate. And you guys can see also, we had a $4 trillion terminal value earlier, right? That dropped to 2.8 trillion just off a few percentages. So with that, I hope this was a very informational video. Make sure to give us a subscribe and a follow, and we will be continuing to, provide information on finance topics, consulting topics, and a lot of things that we hope will help you guys out. Thank you very much.